This 3-step A+ SMC trading strategy is the reason that I am a profitable trader. It was the first ever strategy that made me profitable and still to this day is my best strategy, the one that makes me the most money and is the most consistent. And in this video, I'm going to reveal to you step by step how to trade this strategy, along with a full breakdown of a trade that I took live with my inner circle students, and I made a little over $12,000 on this specific trade. I'm going to break everything down, reveal everything in this video. And if you stay to the end, I'm going to reveal a bonus and I have a special gift for you that you will only know what it is at the end of this video. So stick around. Let's dive straight into step number 1 of the 3 steps. So as you can see on screen right now, this is the exact trade that was produced from this strategy. It's also the exact trade that so many of my members took because I forecasted it live ahead of time with my live trading students. So step 1 is the daily bias. So the daily bias, what is it and how does it work? Daily bias is the idea that we just need to understand what's going to happen on this one trading day in order to consistently make money. And for the daily bias, how you can guarantee a daily bias every single day, here are 2 of the most common ways that I personally build a daily bias. And it's based off of the daily time frame, the daily candle specifically. So you can see here, we have 2 examples, number 1 and number 2. We'll start with number 1. And this is how to understand whether we will have a bearish day. So you can see here we have a bullish daily candle followed by another bullish daily candle that closes above the high. So what you can expect the next daily candle to do, it will almost definitely trade above this high, like so. Now here's the key. If this candle trades above this high, and so that would be the high of the day, and then all of a sudden it reverses and actually trades back down into here, producing a bearish candle, this would be your wick, right? That's how a candlestick works. You essentially have the open, the high, meaning the highest point that price went in that daily candle, the close, and then let's say price ended up trading a little bit lower down to here and then snapped back up, your daily candle would look something like this. And that would be your daily candle, right? You would have your open, high, low, close, right? That is a candle. Now here's the key. If this daily candle wicks above the previous day's high and closes inside of the trading range, there is a very high probability, right, statistically speaking, proven with data, the next day will trade below this low. So this then becomes your target for that day. And if you come into the markets and we haven't yet taken out that low, that is the objective of the day. Now, sometimes what may happen is you may get into the market and we're already below that. Well, that point there, the daily bias is already completed. But there will be many times where you will open that day and price will start to trade bullish, right? So this would be a bullish candle. Price starts to trade toward the buy side, and then it peaks and puts in the high. If you have a candle like this, right, which is counterintuitive to many people, let's say this is your current daily candle, counterintuitive to many people look at this daily candle as a bullish candle. They start trying to buy it. The reality is if you have this daily bias, this is untargeted, meaning we haven't traded through it yet. I want to sell the bullish candle. So I want to get involved in sells. And my objective of that day is to find the high of the day, which you're going to see me do when I break down the trade at the end of this video. So you want to catch the high of the day. And step number 2 will tell you how you can identify that. So I want to essentially catch the high of the day because a lot of the times what happens is price will first trade higher and then it will eventually flip, and obviously leaving a big wick like this, and then it ends up flipping to bearish, right? You will see it many times. When you see a bearish candle like this, right, wick heavy and then bearish. When price was up here, it looked extremely bullish. Everybody was scared to sell this candle. But I want to get involved when the market seems like it's going to trade higher, right? That is how you get your risk reward. And this becomes your target, again, with a statistical probability. Now, if we look at scenario number 2, which is a little bit of a different variation. So let's say, for example, we again have 2 bullish daily candles. Let's say price opens on this day we start trading bearish to begin with, and then maybe we shift to bullish, which happens almost all of the time. On a bullish day, you will start bearish first, and this becomes a bullish candle. And then let's say it has a little bit of a pullback, which obviously leaves behind a wick. Well, if I come into the market and I see that the previous day, so I'm on the new day now, this day has broken and closed above the previous day, that usually indicates a continuation, meaning the target for that day is simply going to be the highs up here. Now, again, in some occasions when you come to the market, you may be at the market and we are already above this high. But sometimes you will come into the market, price may be put in, it opened up, it went high a little bit, and then price starts coming down bearish. Now, whilst this candle is building and it looks bearish right now, that is exactly when I want to be buying it. I want to try to find the low of this day, because statistically speaking, the likelihood is that we are going to shift back from bearish, right, and give a long wick and then shift back to bullish, right? And I want to be the buyer at these lows, and I want to get out of my position at these highs. And so that's how we can ultimately play the daily bias, right? That is step one. So step one is essentially having a daily bias. Now, if we go back to the trade that I executed on this day, so this is how the current day looks. Now notice here, this candle represents the current daily candle. So when we move, you can see this daily candle moves with it. This is the current daily candle projected on whatever time frame that I'm on. So I'm on the 15-minute time frame. You can see that that candle represents this, right? So you can see right now that we have a very, very bearish daily candle. However, if we go back and we look at the previous day before 5 p.m. when the daily candle opens, this is the previous day's candle. So if we go onto the daily time frame, you can already see that this is what this daily time frame looks like. And again, ahead of time, I have already called out to my members that we were going to get a reversal most likely on Wednesday. For reasons that I won't explain in this video, I don't want to confuse you. But notice that this is how the daily candle finishes, right? This is 5 p.m. I have a target of this daily low here as my target that I expect price to reach to. So notice now the new day is about to open, and this is the daily candle. While that is a very, very bullish daily candle, we have broken and closed above the previous day's high, plus a lot of other highs. Very, very bullish. Well, I would be expecting a continuation higher, but in an ideal world, which would give me an A+ setup, first, I want to see a bearish retracement like this. I want to see price open, start to come down like this, right? Leave a wick at the lows, and then reverse into a daily bullish candle. And that would look something like this. And my objective is simply to get involved at the low of the day. You can see it here, right? Here's a daily candle. This is where we close that day. The new day opens. First, it comes high, and then it goes low. You would have made a lot of money getting involved at the high of this candle if you can find the high of the day, which is what I'm going to show you to do in step number 2. So that is the daily bias. And again, this is next level source that I am revealing. This is the type of source that I literally only reveal inside of my mentorship. So I don't know, I'm feeling generous today. This is what I'm looking for. Again, you can see now the new day has started. So you know that the previous day's high is here. Very, very big bullish candle. The daily candle starts at 5 p.m., right? So the daily candle opens here and it's extremely bullish, and it closes at 5 p.m., which is right here when the new candle opens. So this is the high, this is the close. So we open the day. Now, again, a lot of the times price will just maybe continue trading above the highs and you can't capitalize on the daily bias. But on this day, this is not my trading session yet. I have to wait for my trading session. Notice that we do not take out the previous day's high. In fact, we're coming for a retracement. And you can see here, now my London session begins. So this is a London session trade. And again, this trade was live called ahead of time to my inner circle members, which, by the way, if you're a trader who is serious about becoming profitable and doesn't just want a course or a community, but actually wants to see somebody live trade every single day and trade alongside them, then you can feel free to register. The link is in my description. But you can see here, this is the London session. Now, this is the session that I'm trading. So I now know that I'm expecting a bullish continuation. There is my swing high above these highs. That's my target for the day. Plain and simple. That is just the daily bias. Notice that this daily candle is extremely bearish. So at some point, I want to find the low of this day, so the low of day, and I want to be a buyer at the low of day, and I want to get out of my position at the previous day's high. It is literally that simple. So how do we do that? Well, moving into step number 2 helps a lot. So step 2 is my intraday bias. This is what really enables me and gives me an additional layer of confluence. The daily bias, by the way, is a great concept. However, the intraday bias is more important because some days you might have the daily bias already finished, but the intraday bias will never let you down. So what is an intraday bias? For me personally, an intraday bias is a 15-minute trend. That's it. I am an intraday trader. I am a scalper. I want to get in and out on that one specific session. That's it. So I need to identify the direction of that session. And the way that I do that is I use the 15-minute time frame, which many of you have already known by now. I use the 15-minute time frame and I'm just identifying the trend of that 15-minute time frame. I have a very specific way that I identify highs and lows, and I identify swing lows, swing highs, and then I identify the trend. And so we have, as you can see here, a higher low, meaning that this low here is higher than the previous one, indicating bullish structure. Then we have a higher high, right? A break of structure, again, indicating bullish structure, pullback, higher low, continuation, break of structure, higher high, pullback. And now what we're anticipating is what? At some point, probably a higher low and then a continuation. So I need to make sure that the 15-minute time frame is aligned with my daily bias. The intraday bias and the daily bias need to be aligned. This makes for an A+ setup. So it's a very simple thing. Now, a lot of the times, this is what we're told market structure looks like, right? Very simple, very easy to understand, swings. The reality though is honestly a little bit more complicated. A lot of the times structure maybe delivers itself like this, right? And this can really confuse people from time to time. This is usually how the market looks like. Now, for me, nothing changes. It's just as easy to read. But I'll highlight some of the mistakes that a lot of people make when trying to identify the trend of the M15 or an intraday bias in general. And that mistake is that they use internal structure. So for me, I'm using the external structure. So swing low down here, swing high up here. That's my base point framework. What you can do is you can take the low to the high here. Let's just change this color. The low to the high, drag that across, simple box method, right? It's so simple. And anything inside this box is internal structure. So you don't get confused. Because what happens is when we put in a high, price comes lower, but it doesn't go in straight lines. Price usually comes and trades like this. And so a lot of the times what happens to traders is price starts coming back like this and then does this. And they're like, oh, okay. So we have a high, we have a low, we have a lower high, lower low, lower high, lower low. Okay, great. Now it's time for me to sell. When the reality is we are still bullish. And actually the lower we come back into this price leg, into the discount of the price leg, the higher probability that we're going to extend and continue higher. So this is a really bad idea to be trying to short from here. And then again, we shift internally back to bullish and then we continue higher again. And when we break out of this box, that's a valid break of structure. So when we break out of that box, we have now a new higher high. And if we look back, it's very simple. This is the box. The lowest point inside this box before the break outside of the box is your swing low. It's completely mechanical, like it couldn't be any simpler. This is the lowest point in this box before we break out of that box. So this now becomes my swing low. Not this low, right? A lot of people see price action and maybe, we're up here like this, maybe we're like this, right? And we haven't broken above that box. What happens? Price comes here like this, and they look at this like, oh, okay, low, high, low, high. Okay, bearish. We've shifted in here and we've shifted here. Okay, now I'm going to sell. Wrong. That's why you get trapped on the wrong side of the market. The biggest key, if you want to make it so difficult to lose in the long term, just make sure you have the direction right. Like if you're right on direction, a lot of the times, if you have a good framework to get the right direction of the day, it's very difficult to lose money. But a lot of people get wrong direction constantly. That was one of my biggest mistakes in the beginning, which is why I went so in depth, collected so many years worth of data to make sure that I had solid, absolutely solid rules in place to tell me what the trend of the day is with statistical proof. Everybody's got opinions on what you should do. I prefer to let the data decide for me, not people's opinion. So if you want, go do this yourself, collect the data on what I'm sharing with you. But I'm telling you, what I'm sharing is data verified. Yeah, that becomes it, right? We have a higher high, a higher low, and then a continuation higher high. So when price comes down in here, what am I expecting? I'm expecting that we're probably going to get a higher high, but we need to wait for a reversal, which is going to be step number 4. But before we get into step number 4, we need to go to step number 2. So step number 2, if we look at the market and apply this, here's what we do, right? So you can see this is kind of how the price leg looks. And again, there are many people have their opinions on what the M15 structure should be, or it's very difficult. And I get it. Like some people look at the market and they're like, okay, swing low, swing high, okay, lower low, okay, we're bearish. And they're just trying to short every move down into here, right? And they just zoom like extremely far in. And they're like, okay, this is the M15 trend. Okay, we had a high, we had a low. Okay, we have a high here, we have a low here. Okay, we have a high, we have a low. Okay, now we break this low, let's say. We haven't broken it yet, we're below it. Okay, we break this low, okay, now we're bearish, okay, now we're looking for sales. Or they might zoom even closer and they're like, okay, we have a high, we have a low. Okay, we're bearish. Okay, price is bearish. Okay, price bearish, I'm gonna sell, right? It's confusing, and I get it. I have been in this boat. That's why I understand it probably better than anyone else. I have been wrong so many times in the past on the direction of price. This is actually another trade that we executed live with our members, playing this exact same strategy. But yeah, step number 2 in practice, for me, I have very specific rules. I've spoken about them on the channel before, for me, for what structure is. So in this instance, we were bearish. We were very bearish. For me, I had this as the high, right? Many people then go, okay, this is the low. For me, it's personally not. They say, okay, this is the low. For me, it isn't. This is the low. And the reason for that is very, very simple. I use a mechanical method to calculate whether we are actually bullish or bearish. And I do it specifically based on candle closures of breaks below lows with a minimum of 3 candles, right? It's a literal checklist of a rule that you have to follow. And none of these break continuations do that because they are all wicks, and some of them maybe 2 candles. Everything wicks below this low. Then it becomes a new low, and then we only wick below it, then the new low. So this is the swing high, this is the swing low. We break above that swing high. So now we've shifted bullish. So when this high got taken out, we had shifted bullish. At that point, you can see that this is the high. This gives me exactly what I need, which is at least 3 bearish candles that succeed each other, that break below each other, that put in a swing low, that give me a new high. So higher high, higher low, higher high. So now I know my swing structure. This is my swing low, and this is my swing high. So now I've been able to isolate it. You see, when you have a bullish day, this is my swing high, which is also the high of previous day. And this is my swing low. So I know that objectively speaking, there is a low probability that price is going to trade below this low. For many people, they might look at this as one bullish leg, and then they might mark out their fib retracement and they put their fib on here and they're like, okay, I'm going to wait for price to hit 50%, or I'm going to wait price to hit the 61% or the 78.6% retracement. And then I'm going to try and buy. Wrong. The actual swing low is here and the swing high is here, right? Again, a rule that I built myself and tested myself with years of data. So I know that it won't let me down over an extended period of time. So that is step number 2. I now know that we are bullish intraday and we have a bullish daily bias. This makes for an absolute A+ setup. It's a peach of a setup. But we need to have step number 3, which is the liquidity. So I'm going to bring price back just to here, right, around midnight Eastern Standard Time. And the reason I'm bringing it back here is there is something very, very important. For me, everything that we've just discussed is incredible. We have the daily bias, which gives you a clear indication of the direction of the day. Amazing. We have the intraday bias, which is literally a godsend. Incredible. But if we don't have this rule here, everything becomes pointless and you will take loss after loss after loss. And that is step number 3, my liquidity sweep of Asia, the daily cycle. You see, Asia, statistically speaking, Asia high and Asia low oftentimes gets liquidated. So if I am bullish for the day, which I very clearly am, which you have seen, using the daily bias and the intraday bias, I'm bullish for the day. But if London session opens like this and I get all my confirmation, but Asia has not been liquidated, meaning the low of Asia has not been taken out, I cannot trade. Because my data tells me that if I try to trade without this low being taken first, I will lose money. So it is imperative that this Asia session low gets liquidated. And that is my step number 3. My step number 3 is that we have to trade below Asia session low. Now, if you look back, notice that yesterday we were actually bearish. So I didn't need Asia low to be taken out. But notice that in yesterday's example, Asia low didn't get taken out. Now there are some days where Asia low doesn't get taken out. But on the good days, especially when we're trending bearish, you can see, right? We're trending bearish, Asia high, liquidated, sell off. The next day, we're bearish, Asia high, liquidated, sell off, caught a really, really nice trade. So again, I'm literally revealing source in this video right now, which again, a lot of the times I do genuinely reserve for my inner circle students. But I don't know, today I'm feeling generous. So I must see this Asia session low get liquidated. That is step number 3. Now I told you this is a 3-step system. The reality is there is a bonus, because what you could do, you could be the trader. Again, this is something I used to look at. You could be the trader who tries to do this, for example, right? You could be the trader who has a bullish read on price. There are so many traders out there that trade a 1 to 1.5, 1 to 2 risk to reward ratio. I'm not knocking you, but for me personally, anything under a 1 to 5, unless it's my other model, is ridiculous. For me, the minimum risk to reward that I will take on my other strategies is a 1 to 3 risk reward. On this strategy, the minimum I would take is a 1 to 5 risk reward. So I used to have a variation where I tried to look at it like this: daily bias bullish, M15 intraday bias bullish. Have to see Asia low get taken out. So I want to basically trade when we take out that low of Asia, and then I buy and I just look at that. That's a 1 to 1.5 risk to reward. So if I risk $1,000 on this trade, I will make $1,540. $540 of actual profit. Really, really, really not a good risk to reward, right? Still probably profitable, really not a great risk to reward. So my bonus step that takes trades that could be a 1 to 2, a 1 to 3 maybe, and turns them into being able to catch sniper entries and literally see 1 to 5, 1 to 6, 1 to 7, 1 to 8. In yesterday's trade that I'll be releasing to you guys soon, that I caught again with my live members, was a 1 to 12.5 risk to reward ratio. And again, there was over $150,000 in student profits from that trade alone. Don't worry, that will be in a different video. Don't worry, I will break that one down. That is a banger. That will be coming in the next couple of weeks. I'll show you how to take those poor entries where you don't know where to have your stop loss, that return 1 to 1.5, 1 to 2 risk rewards, put them on steroids and return 1 to 5, 1 to 6, 1 to 7 with just one simple method. And that is fractals or confirmation. So you see everything we've gone through, right? We explained how when we're bearish, essentially, when we're bullish, we want to be catching the low of day, right? And you can see in this example, it looks complicated, but really we're just, bullish, right? This is the actual structure. We're bullish. Now, when I come into this day, again, I need to see Asia get taken out. So let's say the day starts like exactly today, and then Asia is building up like this. I need to see this Asia low get taken out before my session, which is my London is 2 to 5 a.m. Eastern Standard Time. Asia get taken out, then I need to see this. This model here is the best entry model that you can take from my experience. And it is the lower time frame reversal model, where on the lower time frame, when price is coming down like this, you can see that price is bearish. Eventually, at some point, if the 15-minute time frame is going to go from higher high, higher low to higher high, in this level here, there's going to be a lower time frame shift, a 1-minute shift, a 5-minute shift, whatever it is that you may look for. For me, it's the 1-minute time frame. I need to see the 1-minute time frame on the way down be bearish and then shift bullish. When it shifts bullish, that's my go sign. That is my indication. Now I go long, put my stops on the lows, and then I target these highs. And that's why I'm able to get 1 to 5s, because I wait for pinpoint precision entries with low stop loss sizes so that I can target these intraday highs with great efficiency and a very high risk to reward, which means that I am very easily able to profit. Because even if I lose a few trades in a row, one winner knocks all of the losses and gives me profit. When you have a couple of these winners in a row and you're stacking up 5% on 5% on 7% on 9%, it's ridiculous. Like, there is literally no catching up. And again, like I said, in fact, I'll put a screenshot up right now. 5 years of data between two models, right? the data, and it's the same entry model on both of the models. So let's come back to the London open. So here the London session is opening. You can see at this moment in time, the daily is bearish. I'm expecting that this daily candle will reverse and become bullish, right? That's what I indicated to the members before anything happened. This daily candle that is bearish will turn bullish. That was my daily plan. Now we're in here. New York is about to hit 2 a.m., which means London session opens. I'm waiting for a lower time frame shift. 1 minute structure. So for me, my 1 minute structure, again, you can very clearly see it. The 1 minute here is bullish, right? The 1 minute is bullish, then it shifts bearish. At this point, the 1 minute is bearish. High, low, complex pullback, lower low, right? Break below those lows, lower low, lower high, break of structure, lower low, lower high, break of structure, lower low, higher high, but fails and then goes lower low, swing high, swing low. So the 1 minute time frame here is bearish, and the swing high on the 1 minute time frame is this high. So I need to see this high get taken out. If this high gets broken and we close above this high, that is my green flag. That right now, as we look, sellers are in control. Price is trading lower. I want to be a buyer. I need to wait for buyers to take control of the market. This is what enables me to win more trades, because I wait for the market to show me what it's going to do instead of just trying to act. I could just try and buy right now, but the truth is the only way that I'm going to know that we are going to go to these highs with a good probability is if we get buyers step in and outweigh sellers, right? It's that simple. So what do? We look at this high in here. We wait for this high to get taken out. You can see London session opens. That's my green box right here. London session opens. We're just playing around. At this point, I'm not interested in anything. I don't need anything. I'm literally just waiting. And then boom, that high gets taken. Buyers have just stepped in control. Now people are like, oh, what about the equal lows? You know, liquidity below those lows. Sure, there may be liquidity below those lows. Doesn't mean they have to be taken right now. Could be taken at a later date and time. Might not get taken at all. This is a lower significance than this. So if you're the type of trader who tries to find every little thing that could be wrong with your trade, you will never take a trade. You'll take 1 trade a month, 2 trades a month, because you're stuck in overthinking your trades instead of executing on an edge. The truth is there's no edge that is invincible, that doesn't lose a trade, that isn't imperfect, that doesn't have drawbacks, that one doesn't exist. You have to learn how to trade your edge, trade your data. That is how you win. So that's my confirmation. How do I enter the market? Very simple. 5 minute time frame. You can see here, right? Massive absorption of sellers. Sellers try to push price down. They're trying to push price down. Buyers are defending this level. Buyers clearly outweigh sellers. Then it becomes a case of how can I get 5R? So you can look at this right here, which is 4.9 risk to reward, but then that's only a 1 to 3.67. So what you can do is either A, you can bring your stops lower, right? And take it to a 1 to 5, which is still fine for me in this scenario. Or B, what you can do, and sometimes I do, is instead of holding it in here like this, you just actually extend your take profit to a 1 to 5 toward the buy side. So no matter what you do, whether you pull it down or spin it up, again, different scenarios require different approaches, I'll be honest. You have to understand, and the data is what tells you that. But in general, that is the idea. That's the trade idea. And we'll put it at this high, and entry. For this, I literally took a 1 to 5 risk reward, right? Exactly 1 to 5. That's entry. Great reaction. That's your opportunity to go to break even. Straight through into take profit. Clean, simple, efficient. You are in at 350. You are out at 615. You're in there for 2 hours, right? 2.5 hours in that trade. Everything in your direction. Done for the day. See you later. Trade New York if you want, or done for the day. 5%. Let's say you've got $400,000 in assets under management, right? Many of our members have 400K. 400K, 1% risk, 5% return, $20,000 minus FTMO's profit split of 20%, $18,000 a day on that one trade. For me, I only capitalized 12K on this trade because I only had a couple $100,000 that was in active risk on this specific position. But yeah, that for me, $12,000 a day, nothing crazy. But yeah, that is this 3-step A+ setup trading strategy. Now, the free gift that I told you about, if you stay to the end, you will find that the link in the description. It's a free course. Enjoy.